We are considered far and away the hottest economy anywhere in the world. Not even close.
That's my Bernie Sanders quietly thinking about what BS that is impression. And honestly, that wasn't even the best reaction they cut away to with that. Check out Kirsten Gillibrand's wondrous eye roll. And that's because while Trump is correct that the superficial economic numbers are good, unemployment's down, growth is up and more, the underlying factors are beginning to look troubling. And as we know from the Great Recession, the underlying factors are the ones that are often overlooked and usually the most important. Our economy has been on a sugar high, as I would put it, with Trump superficially propping it up through slashing corporate and wealthy tax rates to spurn short-term growth and loosening regulations to allow for things like an increase in stock buybacks. A stock buyback, also known as a share repurchase, occurs when a company buys back its shares from the marketplace. You can think of a buyback as a company investing in itself or using its cash to buy its own shares. But as you can probably guess, that also inflates the value of the company as well as the company's share price and its earnings per share, which is why for most of our recent history, until the 1980s, stock buybacks were pretty much illegal because they were seen as market manipulation, which they are. But because stock buybacks primarily enrich executives who can buy back their stocks and make themselves richer even when the business isn't doing too hot, well, of course our corrupt government is going to allow it. S&P Dow Jones indices announced Monday that companies bought back $806.4 billion worth of their own shares, including $223 billion in just the fourth quarter in 2018. It was short of the $1 trillion Goldman Sachs predicted in August, but still an all-time record. That means that a lot of the company growth that Trump is touting is artificially inflated for CEO profit. And independent of stock buybacks, there are other troubling factors. Late last week, the yield curve for U.S. Treasury bonds inverted for the first time since 2007. As the Wall Street Journal's James McIntosh put it, the market's most reliable recession indicator is finally flashing red. The yield curve has inverted in the lead up to all 9 U.S. recessions since 1995. Yikes. So what is the yield curve? When the economy is healthy, investors usually demand higher yields from long-term than short-term U.S. government bonds, in part because there's a greater risk that growth will cause inflation to pick up down the line and eat into their interest payments. When the yield curve inverts, the opposite becomes true. The returns on long-term government bonds dip below those on shorter-term ones. In and of itself, it's not the end of the world, but it compounds itself if it freaks banks out and discourages them from making loans since they borrow at short-term rates and lend at long-term ones. And what's more, underemployment has hidden the true state of jobs in this country. While unemployment is down, the amount of people who are making an unlivable wage is still massive. And even the Trump administration seems to notice that the economy could be slowing down. On Thursday, the Commerce Department issued a downward revision of its estimates for economic growth in the fourth quarter, pushing one measure of the full year's growth down as well. Why this is scary news for Trump is that his approval ratings are at an all-time low for a president who is presiding over what the media deems as a healthy economy. The economy and the media's perception of it, and thus the public's perception, has really been his life raft in this sea of public blunders, investigations, some of them failed, and complete incompetence. If that goes before 2020, then he better hold on for dear life, as should we all.